Yes, thank you. We'll take care of that. We do want to let everyone know we are live streaming and recording the meeting, and that has just been started. So I will go through the roll call now. Jerry Abrahams,
Here.
Phil DeFranzo,
Here.
Timothy Hodges, Kathy McKinnon, Commissioner Perez, Franklin Perry is connecting right now. I'll come back to him. Chelsea Ross, Bettina Brown Eyes.
Here.
And Franklin, can you hear us at this point? We'll give him just another second. Matt, I do see that you're on. You're not on the roll call list for this meeting, but I do acknowledge you're here.
Hi, everybody. This is Franklin.
Franklin, excellent. Thank you.
Yep,
All
thank
right.
you.
Roll call is complete. We do have a quorum for the meeting.
Terrific. Thank you very much. The first item on the agenda is an action item, and that's for the resolution for the upcoming or the authority's next single-family bond sale. Do we do a discussion first and then ask for a motion, or is it a motion first and then discussion?
It's discussion, so I'll be making the
Terrific.
presentation. Okay.
I'll hand it over to you, Hazim.
Thank you so much. So good morning, everybody. So like the chair said, we do have one action item from finance. So this is the resolution to authorize CHFA to issue up to 250 million of the Housing Mortgage Finance Program bonds. The sale will allow CHFA to raise additional lending proceeds to fund about 1,021 first-time homebuyer loans. As of March 18, CHFA had an aggregate net pipeline of about 223 million. CHFA will utilize a fixed rate structure and expect to close around May to stretch CHFA's tax exempt issuance capacity. CHFA intends to supplement the issuance with taxable bonds. RBC is assigned as the book running manager for the bonds, and I'll be happy to answer any question relating to the resolution. Thank you.
Any questions? Hearing none, I'll ask for a motion.
So moved.
That was Jerry.
Second.
And that's Phil. All in favor?
Aye.
Aye.
Any nays? Any abstentions? Motion passes. Thank you. Next item on the agenda is a report on the 2024 Series A bond sale that happened last month. And oh, I see my old friend Joe Manito. Is he going to be presenting?
Yes. So
Terrific.
here we have in the room is Joe Manito along with Mike Castle from BofA Securities. So I did provide a memo, but then Joe is going to walk us through what transpired when we sold the 2024 A bonds. So Joe.
Great, thank you. So normally when I make these presentations, there's always something unique or exciting. There was a direct purchase. We changed the duration of the PAC bond. We did this or that, which was different and unique, and it was designed to address a market anomaly or what have you. Essentially, this deal was a little bit boring because everything went well. You came to market, and I always like to see Connecticut come to market at the start of the year because you really sort of set the tone for the rest of the market out there. And as much as we'd like to think that we can distance you from everyone else, the truth is that in order to improve pricing and spreads over the course of time, you have to have sort of the tide raises all ships. And so the fact that you come and you put down sort of a strong marker in the market is exceedingly helpful, not only to you and your cost of funds, but to everyone else in the market who comes after you, because they get the benefit of having the market reset to nice tight levels. And essentially that's what happened. You came to market with a little over $197 million of debt. You had 525 million, so just over $500 million of orders. Of those orders, $174 million was what we call usable, which means that those orders overlapped in various places, and there were certain gaps, if you will, in some of the longer serial bonds, which left them unsubscribed for because everybody wanted to be either at the very front end of the curve or at the much longer end of the curve. To that end, though, the unsubscribed portion was underwritten. That was about $22 million of bonds that the syndicate underwrote to clear the market. The breakout between the retail and institutional orders, almost $90 million of your transaction was retail, which is about 35% of the deal, and as far as orders, and you had $436 million of institutional orders, and 11% of the deal, as I said, was underwritten by the group. The week that you guys came, $1.1 billion of housing bonds was in the market. So that was an exceedingly large housing calendar. You were in the market. Virginia, which is a very strong credit, was in the market. Sunny Mae was in the market. Michigan was in the market, and North Dakota was in the market. No one got better execution or outpriced you. Michigan, which tends to have a little bit of the of a negative sort of connotation associated with it because of Detroit, tends to price a little bit higher in yield. And throughout the course of their transaction, they were higher at the front end in yield by as much as 10 basis points, and at the tail end by about 3. North Dakota was higher in yield by 5 basis points in certain maturities, and as much as 10 later on. The results of the transaction were sort of interesting. When you look at what you were able to accomplish, you got a 4.30 bond yield. Your full spread mortgage rate was at a 5.42, but you're making mortgages above that. And so what happens is $19 million of the proceeds will need to be blended in another transaction because the cost of funds was too low and you're making more than you're allowed to keep. And so essentially, we term those loans zero coupon loans because essentially they'll be participated in this transaction without any interest associated with them, and the subsidy will flow up to the next transaction that you do. And so essentially, what that means is that you've got a future subsidy to help if times are tough on your subsequent transactions. Or what we've seen is that a lot of folks have decided to do taxable and tax exempt combination deals. And if your next transaction has a taxable component, what you can do is shift that extra yield into the taxable piece of the transaction and make more money than you would normally be able to on that piece, and essentially generate that spread over the course of time. So it's a very helpful, circumstance. Right now, although affordability is tough and inventory is low and you have all of these negative things, the truth is that the easiest thing right now is actually selling the bonds, because we can sell bonds right now based upon tax exempt rates and even taxable rates on the blending to the point where you can run a very profitable mortgage program. And that's what's essentially happening for you. A couple of other sort of points to note. One of the drivers of these deals tends to be these PAC bonds. And at most conferences now, what you're seeing is a lot of focus on the prepayment speeds and what we call the bands, how much you promised to sort of stabilize the bond's average life to based upon how quickly you receive prepayments. And you tend to be very conservative, which is a good thing because the prepayment speeds in the Northeast have slowed considerably. And so what you see is that you'll actually structure your deals with much wider bands, giving investors higher degrees of certainty that they're going to get paid to what we call the table, and that their average life is going to be stable the way they thought when they bought the bonds. Investors are quite concerned right now Many issuers are subsidizing, and some are not even bothering at this point to subsidize the PAC bands, and they're essentially breaking those tables, and the investor is getting an extended average life, which is not what he bargained for, but it was part of the deal. It was a risk that he took. And so, some, as you might guess, investors aren't always happy when they take a risk, it doesn't come out their way, and then they're like, oh, well, why aren't you doing it anyway? And so, I think that to your credit, you've basically, every time you come through, you make a judgment as to how fast those speeds are, and you give the investors the deal that they believe that they're sort of bargaining for at the beginning. So, all great things. A couple of developments in the market just to sort of highlight what's going on. Obviously, with the exit of Citibank, we were able to add Mike Kessel, who is one of our competitors and a very strong competitor, along with Ray High. Barbara Feldman, who you know from the past, has retired. She went out on her own terms, and she's enjoying retirement now. As Barbara told us when she retired, she figured that it was going to take two men to replace her, and so that's what we did. We followed her direction there. One or two other sort of developments in the market, and I was talking to Hazim about this. We are seeing some of the federal home loan banks come in and try and buy bonds directly from issuers, and that is, a process that we're trying to figure out how to intermediate to the best of our abilities. What we've seen is that oftentimes when an HFA is approached by an FHLB, the deal seems sort of too good to be true. They'll come in and they'll say, we're going to save you a couple of basis points on your transaction or on the bonds that we'd like to buy. So tell us what the rate is, and then we'll determine what we're going to pay you. And we'll pay you, essentially a 2 basis point benefit. So we'll lower the yield by 2 basis points. Well, the downside to that is when we run an order period, oftentimes we change prices and we're able to achieve better pricing. And so in a particular recent instance, which happened last week, Federal Home Loan Bank approached one of our clients, and rather than sort of have them run the process, we decided to take matters into our own hands, and we essentially put them into competition with the rest of the market. And we did a sealed bid on that, essentially, and told them, look, you're going to now have to bid. You're going to have to figure out what you think is the price, not what we tell you is the price. Ultimately, when you compared that to what we thought we would have gotten, rather than saving 2 basis points, we were able to get them 10 basis points of savings. And so there are a lot of different techniques that we're able to employ. And so to the extent that these things become more and more common in the market, there are strategies for dealing with it. And one of the things that we at B of A have been very good at is running competitive processes and bidding. And for 32 years straight, we've been the #1 firm in the competitive market. And so when the Federal Home Loan Bank came to us and we decided to sort of turn the tables on them, I don't think that they kind of realized who they were dealing with in that instance. So with all that said, I apologize because I have a handout which I thought everybody was going to be here, and I'll make it available electronically, but I'm going to pass it out in the room because we always tell you guys what a wonderful job CHFA is doing relative to the competition. But I wanted to put down some numbers next to it to let folks see exactly what we meant. And so the handout basically shows the top 10 issuers and then Connecticut and all of your neighboring states. And it looks at the total issuance since 2020. It looks at the population because obviously you can only make loans to people that are in the state. And clearly, larger states have a huge advantage versus smaller states. It shows what the volume cap is, the breakout between single and multifamily, AMT, non-AMT, a variety of different metrics. But what it really shows in the last column is if you adjusted for population, how would you look relative to the competition? And save for two very small states and New York, everyone underperforms on a per capita basis CHFA. And so when you actually look at the rankings, you're 12th in overall volume, you're 29th in population. So way outperforming in that standpoint. You rank number 6 overall in single family volume. And as I said, 12th overall in total volume. However, you've only got 3.6 million people in the state, whereas, you know, New York's population is 19.5 million people. New York City's population and New York's volume is dominated by multifamily. New York City's population is 8.25 million people. And so that's kind of what you're fighting when you compare yourself to, you know, the bigger population centers out there. So, you know, I'll make this available, but I think that the long and the short of it is you basically dominate. You do 95% of the issuance in state. There are small scattered, you know, things in East Hartford or New Haven, New Canaan, Stanford Housing Authority, or Waterbury Housing Authority that get done. But basically, you do everything in the state. You do a tremendous single family business, and you know, on an adjusted basis, you're killing it. So, you know, I think kudos to staff for doing what you do and for, you know, getting that kind of result against some other competitors that are, you know, much larger in population out there. So with that said, let me stop and take any questions that folks might have.
Hi, it's Phil DeFranzo. When you say, like, what metrics comparatively against the other housing agencies, is it prepayment speeds? Is it loan quality? Is it like, you know, you say that I mean, I've always said that because I deal with a bunch of other agencies as a lender, that we're head and shoulders above the other people that we deal with in almost all aspects. But just from a pure perspective, like what metrics do you see that we're exceeding on?
Yeah, I'm measuring success by volume of debt that you sell.
Okay.
And so, you know, everything is in that sort of light. And, you know, you can look at some of the subcategories as to, you know, how much taxable debt you do, how much AMT debt you do, how much non-AMT debt you do. And essentially you do 100% of your volume cap allocation. And then because you have even greater demand than that, you augment that with recycling on the, you know, AMT and non-AMT side. So very few other states are as judicious about capturing some of the old AMT debt and recycling it. So that's one area that you outperform greatly. And the other is that, you know, you do, let's see, 10% of your volume as taxable debt right now. So, you know, that's a pretty significant chunk. The numbers there tend to be skewed. Some of the bigger issuers have large multifamily projects that wind up getting done with taxable debt. But, you know, again, I think that your ability to utilize all your volume cap, your ability to do more than just what is sort of preordained as volume cap, all of those things sort of stand out. And when you actually look at the top 10, if you will, some of the states in there, so I'm going to pick two in particular, one of which is Washington State HFA and the other is California HFA. The reason that their volumes are so big is actually because they re-securitize a lot of loans that Citibank essentially was the originator for. And essentially what Citi does is they have a huge CRA need around the country, and they go and they make various loans. And essentially once their risk bucket is filled up, they need to liquefy their balance sheet again, and they'll go and they'll sell those portfolios off in the market. They'll essentially do a tax exempt pass through of those loans. And in California and in Washington, when they do that, they do it through the HFAs. And so it shows up as volume for the HFAs. But the true test is that they're really not, they're only sort of a pass through and a conduit for that execution. They're really not making those loans. And so, it sort of distorts these statistics a little bit. They look better than they really are as an agency.
Any other questions?
Yeah, I just had one question, and congratulations on hiring Mike. I think it's a real, it's going to be a real attribute to you guys. So the one thing that I always just think, and I apologize if it's in the pricing book and I missed it, then I apologize. But the one thing that I always the one number that I think is always most important is I just like to see, and I know that we perform really well, and I know our bonds trade really well and really rich, and you guys typically do a really great job for us. So I'm not concerned about that at all. But the one thing that I'd like to just see is just what is our, like every time we do any one of these deals, what's our spread to the index, to whatever the index, the MD index, what it is, and what it is for this deal versus what it is for last deal. And then of course there's going to be variations, but that's the one, just so that we could sort of see how, how our ultimate performance versus the index are essentially our credit spread or credit premium, depending on, I guess, where we are versus the index, how that changes for each deal. And that I just didn't see anywhere in the pricing book. Like, and again, I need to see it historically, right? I know you can give me this for this deal, but then I have to go back and look at everyone else's deal. And
I have a database, and I can do, your last year's deals and this deal, and give you your spreads to the index. That's easy enough. I'll package that up and send it to Hazim to forward.
Yeah, Hazim, it'd be great if we could just have all our underwriters just always include that. So then we could quickly see how our performance on this deal on a relative basis compares to our historical performance. Really simple, just one quick look. And I know it's going to vary depending on structure and all that. That's okay. But that seems to me the most relevant statistic that we should care about.
Jerry, thanks for the shout out. We could also provide comparables. That is not just how Connecticut performs over time.
But I know we're going to be rich to our comparables, so that's not what I care about. Like okay. I get that you guys are always giving us the comps. I just care about how we do versus what we've done historically. It's really just a peer group of one.
Okay,
it'd be great to see the trend too over time.
Exactly.
Is widening, or if the spread is narrowing.
Exactly. I just want to see one page chart. Here's our spread to MMD for single family on our 4 deals that we do a year, 3 deals we do a year. Here's what it is, and look, and it's going to vary. But if it starts to either trend or we stick out, that needs an explanation. And if it's just in the realm of the normal kind of noise that we have at deal execution, that's fine, no big deal. But if it is trending one way or the other, or there's a data point that sticks out, well, then that would be much more relevant.
I see that in the memo also. They did adjust spreads, had to widen a little bit, but the last line of the memo does say that they were through other HFAs by between 5 and 10 basis points. But yeah, what is
we always are
the final spread?
Yeah, but we always are, right? And that's for lots of reasons, because of Connecticut's tax rates and there's all these technical reasons that we're through other people's spreads, and we're through other people's spreads because we are, right? And we trade based upon our historical performance, which is good because it's to our benefit. Right. But that's all more reason why we really should just be looking at benchmarking versus ourselves, in my mind.
Okay, so we'll include it in.
Thanks, Hazim.
Not a problem.
Any other questions?
I think I blew my 5 minutes.
I had a couple of questions. Joe, you said that there were a couple of orders that were undersubscribed. Do you remember off the top of your head what maturities those were?
Yeah, it was the middle range of serial bonds that was undersubscribed for, and that we essentially put in member orders to fill. So if you look on one of the charts after the pie chart, there is something which talks about the pricing progression, and the chart shows in the last column oversubscription, and you can see, anytime you're below 1.
Yep. Okay, I see him now. You're at a bunch.
So, what wound up happening was a lot of the middle of the curve was tough, and that's where we raised yields. But then on the much larger maturities of 2051 and 54, we lowered the rates by 5 and 6 basis points. And so although there are a lot more sort of +5s than -5 and 6s, if you look at, on a weighted basis, you actually over the course of the day outperformed where we went out.
And this would be a great page to just put in a column that shows what the final MMD spread was. Maybe
Okay.
where you started and where you ended up. Okay. And I had another question on the sealed bids. What maturities were those done in?
No, the sealed bid was done for another client. That was the where they had the FHLB.
Oh, it wasn't this one. Okay,
It wasn't this transaction.
right. And was it the first maturity?
Yeah, no, none of these were done as sealed bids. Everything was offered, especially for you guys. Retail is such a dominant factor that, if we were to sort of carve them out, we would have really sort of been taking bonds away from retail.
No, I understand it wasn't for Connecticut, but I was going to do it for another client. I was just curious what maturity
In
was.
the other transaction, it was actually the first 10 years, and we were. It made more sense there because it was a taxable transaction, and so taxable tends not to have the same kind of sort of retail order flow associated with it. It was actually more than just the first 10 years. I mean, it might have been like the first 15 years of taxable maturities.
Okay, got it. Any other questions? Okay, well, Joe, thank you very much.
Thank you.
The next item is the financial reports from Ms. Murphy.
Good morning.
Yeah.
Before you are the financial reports reflecting the results for the first 2 months of the year. On the revenue side, mortgage loan and investment interest revenue are coming in 1.9 million above budget through the end of February and 5.8 million higher than last year. The year-over-year revenue variances are being driven by the increase in interest rates on the authority's short-term investments. On the expense side, bond interest expense is 1.6 million above budget and 4.2 million higher than last year. The authority's outstanding bonds as of the end of February are 252 million higher than the same time last year. Servicer fees are 2.6 million above budget through the end of February and 2.2 million higher than last year. The increase in single-family production is driving this variance. John will be providing more details on production in his upcoming report. Administrative expenses are coming in 1.1 million below budget and 760,000 higher than last year. When you exclude salaries and benefits of 4.9 million, the current year expenses are 418,000 higher than last year. Bond issuance costs are a tick under $1 million below budget. As you just heard, we had our first bond sale a few weeks ago. We expect to recognize the majority of those issuance costs during the month of March. And lastly, the change in net position is above target by 373,000. Are there any questions?
Any questions for Allison? Well, hearing none, thank you very much, Allison. The next item on the agenda is John doing the production and delinquency reports.
Good morning. As Allison said, our loan purchasing volume remains very strong through February. For the month of February, authority purchased 528 loans, totaling roughly $132 million, which is the largest number of loans purchased since November of 2001, or 22 years ago. 99% of the February's production was securitized, 522 loans totaling roughly $130 million. The remaining 6 loans totaling $1.4 million were whole loans. The average loan size was just under $250,000. And February's month-end mortgage-backed security balance was $2.8 billion, which was an increase of $119 million over January. And our whole loan portfolio, our our whole loans continue to show a gradual decline, declining 38 loans to about roughly $3 million. The total portfolio balance of $1.1 billion. The overall single-family delinquency rate remains very, very low. It decreased 10 basis points over from December to January to 1.36%. And our loans in foreclosure, again, quite low, balance at $10 million, which is $10 million less than January 2023, or 80 loans. And for the month of February, Authority also funded 262 down payment assistance loans totaling $4 million, averaging $15,700 per borrower. And Authority also funded 153 time to own forgivable loans totaling $4.5 million, with an average loan size of $29,000. On our multifamily side, there were no new loan closings in February. The overall portfolio decreased by 1 loan to 581 loans. The portfolio balance $1.3 billion. There were 8 permanent loan delinquencies, but our construction loan, our delinquencies in multifamily are also very low, less than 0.5%. Any questions?
Hi, it's Phil Franzo. So you said, I was just curious on the number of units that we did versus the number of those units that were either down payment assistance or time to own.
Yep.
How many? Do you know how many that? So you did 522?
528 loans.
Oh.
And then 262 down payment assistant loans and 153 time to own.
Okay, that's great. Okay. Perfect.
Any other questions for John? Okay, moving on. The last item on the agenda is approval of the minutes of February 29th, 2024. Are there any corrections or additions that need to be made? Okay, then I'll ask for a motion to move the minutes.
So moved.
Thank you, Phil. Second?
Second,
Not sure who that was.
Franklin.
Franklin, terrific.
Yep.
Thank you. Well, then all in favor? Say
Aye.
Aye.
Any nays? Any abstentions? Oh, I'm actually going to abstain. Sorry. Because I was not at that meeting. So do you need to do a roll call now because it's not a full?
Yeah,
Okay,
why don't we just do that, just to be safe?
so those do a roll call for the ayes, please.
Sure. Jerry Abrahams,
Aye.
Phil DeFranzo,
Aye.
Timothy Hodges, Kathy McKinnon, Commissioner Perez, Franklin Perry,
Aye.
Chelsea Ross, and Bettina Brownhouse.
Abstain. I believe.
The motion carries, yeah.
Terrific, thank you. There being no other items on the agenda, I'll move for ending the meeting.
So moved.
Second,
I'll second.
all in favor?
Jerry.
Aye.
Aye.
Right, the meeting is adjourned at 9:34, I believe.
Thank you.